In this video, you'll find out how much you really need to retire. Good day to you folks. Money Jim here, your money pal. Most folks reckon how much they need to retire goes something like this. Well, I could live off $50,000. So if I divide that by 4%, I'll need a portfolio worth $1.25 million. If I earn 10% from stocks each year, that means I'll need to save. Stop. There's an awful lot folks get wrong when it comes to planning for the day you give up work. Lucky for you, Jim here's got your back. See, I've advised hundreds of retirees and I've seen it all. So in this video, I'll show you how to work out how much you really need to retire so you don't make the same mistakes too. Stick around to the end because I'll run you all the way through an example of how to figure out what you need in retirement step by step. Now, most folks count on spending 20 to 30% less in retirement. It's a very broad assumption, but it works well enough. By that time, you'll probably be mortgage-free, debt-free, and the kids are left home. You'll also be spending less on transport, clothing, and entertainment. Of course, you won't be saving for retirement no more. But on the flip side, you'll probably spend more on vacations, hobbies, and healthcare. Now, here's the first thing folks get wrong. They compare how much they think they'll need in retirement to how much they spend in now. So if you're spending 50 grand now, you count on needing, say, 35 or 40. If you're spending 75K, you reckon you need 50 to 60, and so on. But you ain't retiring now, are you? Nope. You might be retiring in 20, 30, 40 years or more. Let me ask you this. You reckon things are going to cost the same as they are now, 30, 40 years into the future? Of course they ain't. They're going to cost more, a darn sight more. We all know the reason why. Inflation, that's why. Now the US Fed and every other central bank always trying to keep it at 2%. They ain't always good at it. So the average long-term inflation is closer to 3. And with that kind of inflation, if something costs $100 now, that means it will cost $134 in 10 years, $180 in 20, $242 in 30, or $326 40 years from now. So by the time you reach retirement, that $50,000 or however much you counted on to live off will be worth pocket change. Here's what you'll actually need depending on how much you want and how far away your retirement is. Those are some pretty big numbers, ain't they? But hard to believe as they may seem, don't forget, those ain't amounts in today's numbers. 30 years ago, in 1995, the average wage in the US was less than $25,000. 40 years ago, it weren't even $17,000. Imagine telling them folks back then the average wage in 2025 will be over $60,000. That's nearly 4 times what it was 40 years ago, but that's 3% annual inflation for you. So if you don't consider inflation, your retirement plans could go up in smoke. Okay, so moving on to another real common mistake folks make, using the 4% rule. Now, a real quick bit of background. The 4% rule was developed to work out the safe withdrawal rate, or in other words, how much money you can take from investments with next to no chance of running out of money. Research was based on a portfolio of 50% stocks, 50% bonds, and looked at returns all the way back to 1926. It found that no matter how bad markets did, by taking 4% and increasing it each year by inflation, that portfolio never ran out of money over 30 years, which is the assumed maximum length of retirement. Now, because it's pretty simple, plenty of folks ran with it, but there's some flaws. A lot of portfolios ain't 50-50 stocks and bonds. If you got more in stocks, you'll have more ups and downs. If you got more in bonds, you might not get enough growth. That's not to say you should have a 50-50 portfolio, but if you don't, you shouldn't rely on the 4% rule. Next, the rule. Don't adjust withdrawals for market conditions, which plenty of folks do in real life. And it don't tell you what would happen if your retirement lasts longer than 30 years, because you either retired early or you living longer than average. So what should you do with the 4% rule? Use it as a starting point, not a rule. If you're likely to be retired for more than 30 years, ease up on 4% and maybe shoot for 3 or 3.5. If you're going to have more than 50% in bonds in retirement, which by the way most target date retirement funds do, you probably want to aim for less than 4% as well, because your growth potential is lower. If you invest more than 50% in stocks, your ups and downs are going to be bigger, so you're probably going to have to ease up on your withdrawals when markets slump. And talking stocks and bonds, the next thing so many folks get wrong is their investment return expectations. Now, when planning for retirement, nearly everybody bases it on markets behaving themselves with nice, smooth returns. But let me tell you this, it don't matter which market it is, they never go in a straight line. Sure, over the long term, they'll average out, but let me tell you something else. By the time you get close to retirement, you'll have seen firsthand some big market ups and downs. But more often than not, you won't want that no more when your lifestyle depends on your investments. So what does nearly everybody do? They lower their level of investment risk the closer they get to retirement. So those 8 to 12% returns you counted on the entire time leading up to retirement are likely to be lower the closer you get. Not because markets won't be as good, because you probably won't have the stomach for 100% high-risk investments like stocks. You might think you will, but take it from me. I've advised hundreds of retirees, and 90% of them take a more cautious approach. And when you invest in lower-risk things like bonds, you give up some potential for gains. So how does that fit in with your retirement calculation? Well, you either got to lower your average return assumptions, or assume higher returns in your early years, and then start reining them in the closer you get to retirement. If you invest in one of them target date retirement funds, how much you invested in stocks, and therefore your return potential will start declining more than 30 years before you get to the target date. Now, over the very long term, stock markets average about 10% a year, and for bonds it's about 5%. Of course, it don't mean those are the returns you'll actually get. That's just a guide. Another thing those numbers don't show is the impact of costs and taxes. Now, you might have a Roth IRA or some other tax-advantaged accounts, but I'm guessing at least some of your investments will be taxable. And wherever they held, there'll be costs. So go knock a couple percent off those returns so you end up with 8% for stocks and 3% for bonds. Now, you can either get all sophisticated and work out your returns as they slide from 100% stocks or whatever portion you started out from down to whatever percent you ended up at in retirement. Here's an example. The other way is just take an average of those numbers, which in this example is 7%. Don't forget that's just an example. And whatever numbers you use, remember those are just long-term averages. Chances are they could be way off over 5, 10, or even 20-year periods. For that reason, you also got to factor in what happens if markets or your investments don't perform like you hoped they would. What would happen if market returns were below average? Or if there was a big crash right before you retired and you lost 20 to 30% of your money? Could you still live off your investments? Because if not, you either got to save more for retirement to give you that safety cushion, or consider delaying retirement by a couple years to allow your investments to recover. I know this all might seem like it's getting real complicated, but retirement planning ain't so straightforward. If you walk into it without considering inflation, you expecting unrealistic returns, you didn't think about what could go wrong, your retirement could end up looking real different to how you imagine. Now, real quick word on Social Security. Some folks deduct what they think they're gonna get from their retirement income needs. Other folks don't, because they reckon Social Security might not even exist by the time they get there. I think it would be a real brave government to cut Social Security completely, but I think we can count on the retirement age creeping up to 70, maybe even high in the future, and maybe benefits not being as generous as they are now. So if you do plan on receiving Social Security, you might want to assume you won't get as much or get it as soon. So let's finish off by putting it all together and looking at a step-by-step example. Jenny and James are married. They're both 30, earn $150,000 between them, or $120,000 after tax, and plan to retire at 65 or 35 years from now. They've already got $100,000 saved up and reckon they'll need $64K a year from their investments in today's money to live a nice, comfortable retirement. So let's inflate that $64K to see what it could be in 35 years. it's $180,000. Now both James and Jenny are currently invested 100% in stocks, but they've been listening and plan to enter retirement with portfolios of 65% stocks, 35% bonds. Using long-term average after-tax, after-cost returns of 8% for stocks and 3% for bonds, they calculate an average return of 7.1%. Call it 7%, because Jenny and James will end up with more in stocks than a 50-50 portfolio. They know they can't rely on the 4% rule. So even though they're gonna start out taking 4%, they're prepared to lower that to 3% when markets drop. Based on the starting point of 4% though, that means James and Jenny need a combined $4.5 million by the time they reach 65. They plug their numbers into an online retirement calculator and find out they need to invest $2,500 between them each month, increasing by 3% each year as their earnings go up. That's about 25% of their current after-tax earnings, which is what I recommend in my 2.5 quarters budget. By the end, that could get them the $4.5 million portfolio they need. And if they don't, either because long-term returns ain't being as strong or the market slumps right before they retire, they plan to carry on working a couple more years to save a little bit extra and give their investments time to grow more or recover. So there you have it. That's how you work out how much you really need in retirement. The figures are probably higher than you've been led to believe, but it's better you know how it really is, so your plan's more likely to work out the way you want them to. See you next time, sunshine.